Okay. Yeah. Okay, so it's from flavor base. Okay, no.
Has picked up your quizzes? Like 100 something left, so people have just given up and picking up the quizzes, I think. Okay, quick reminders, though you shouldn't need them. Next week is when your project is due, a week from today by 5 o'clock. It doesn't have to be in class. No Excel spreadsheet, just a report with, it's just summarizing your DCF valuation. That story page alone tells me everything I need to know about your company. So give me the story page from your DCF, a pricing, basically the multiple you picked, a very quick description of the comparables and a regression if you ran one, and a pricing. For 1 in 10 companies, maybe what we talk about today of applying option pricing will work, and then a recommendation. So this is in Purple Prose. I'm not looking for extended discourses. You don't have to give me business descriptions. I kind of know what most of your companies do. So if you want to give me a description, make it short and tell me what you think its basic business is. But make it a PDF file. It's easier for me to put in comments into a PDF file than it is, but there'll be one report per group. So I'd prefer that one person in the group send me that report rather than each of you send me multiple copies of the same one. Make sure all your group members are in front in alphabetical order. It makes my life a little easier when I enter your grades into Brightspace. So very simple logistical stuff. Your final is 48 hours later. So things come bang, bang. So project final is, I think, on the 10th. I think the actual time is 1:30 to 3:30 is, I think, the official time. I'll make sure I'll confirm that for you because sometimes I get the times differently. So it'll be a 2-hour final. It'll be open book, open notes, everything in the class, which is a lot of stuff. Yeah. So it'll be everything in quiz 1, quiz 2, quiz 3, and the stuff after. So with that lead in, let's complete our discussion of real options. I was talking about how companies sometimes stay below their optimal debt ratios, not because they're being irrational, but because they value financial flexibility. And I give you a very simple way of judging whether that makes sense. I said, when you're under levered, when you have too little debt, your debt ratio is 10%, your optimal is 40%, you're accepting a cost of capital that is higher than it needs to be. Let's say it's the case of Disney, it was like 50 basis points. You're accepting a higher cost of capital. You're saying, why would I do that? Because you value financial flexibility, and we said financial flexibility is an option to take great projects that you don't see on the horizon right now, but might unexpectedly show up. You can value that as an option. It's a tough option to put numbers on, but in the case of Disney, I came up with 85 basis points. So there's the trade-off. By being under levered, they give up 50 basis points a year, but by being under levered, they get this flexibility option that's worth 85 basis points. Which means that they should stay under levered, even though it looks like their cost of capital is high. As I said, that option itself is tough to get the inputs on. The implications, though, are very interesting.
If you think about what kinds of companies should value financial flexibility the most, so these are the companies that should be most underlevered. Companies with capital constraints should value financial flexibility a great deal more than companies without capital constraints. You know, the implications are, right? I would expect private companies to be more underlevered than public companies. I would expect small companies to be more underlevered than large companies. I would expect emerging market companies to be more underlevered than developed market companies. I would expect markets after crises to pull back on debt a lot more than companies that have been in good times. So first thing that matters is capital constraints. Not all capital constraints are external. Some are internal. You know what I mean by that? Many companies will refuse to issue new equity. Once they're public companies, they hate issuing new shares. Why? There's dilution. So some of this is internally set, and that often will also feed into capital constraints. The more internal capital constraints you put in, the more underlevered you need to be to make up for the fact that you can't issue equity at the drop of a hat. Second, the more unpredictable your reinvestment needs. Remember, it's an option. Option value comes from uncertainty. If you're certain about your future reinvestment needs, you don't need flexibility. You just set aside the money. Infrastructure companies don't need flexibility. They know exactly how much they're going to spend. The more unpredictable your reinvestment needs are, the more you will value flexibility, the more underlevered you should be in businesses with a lot of uncertainty. Within businesses, some companies grow with internal investments, some grow with acquisitions. Acquisition-driven growth is far more unpredictable than internal investment growth because you don't know what you'll have to pay, who you're going to buy. I would expect companies that grow through acquisitions to hold back on debt capacity more because they value financial flexibility. But here's a final, and to me, the most significant component in whether you should stay underlevered because you value financial flexibility. Why are you preserving this debt capacity? Because you want to take investments, right? If you're in a business where the average investment earns its cost of capital, what's the net present value of that investment? It's zero. In other words, if you're in average or bad businesses, don't even talk to me about financial flexibility. I don't want you to have any. But if you're in a business where projects make significantly more than the cost of capital, then we can talk about being underlevered. So if GM and Ford say, look, we'd like to be underlevered because we value financial flexibility, my reaction is not on my watch. Your businesses are not good enough for that to be sustained. So the better a business, the more you value financial flexibility. What this does is it gives you room for, when you look at a publicly, especially in corporate finance, when you talk about optimal debt ratios, give companies some grace when they're underlevered, saying, in this company, that's okay. It's a young company, it's a small company, it's a capital restricted company, it's in a great business, therefore that's okay. Which brings me to the last application. This, in an ironic way, is the most common way in which you can apply options in the context of valuation. I'm going to argue that equity in a publicly traded company takes on the features of a call option. And here's why. The first is equity is a residual claim, right? Basically, you get whatever's left over after everybody else has been paid, both in terms of operating cash flows every year and in liquidation. The other feature of equity in publicly traded companies is limited liability. Tell me in practical terms, what does that mean, limited liability? Yes. Most you can lose is what you pay. That's large enough. But remember, your broker can't call you and say your share price went to minus $31. Please send $31 more. As opposed to a private business where equity can have unlimited liability in a public. So those two features conspire to create the equity option. So let's set up the option. What you have, so you guys play the role of equity investors. I'm lenders to a company, right? So you run the company. Can equity investors in a company choose to liquidate the company if they want to? Yeah. No, you get together in a meeting and say, what, you have to get the board of directors to go along and say, okay, we're going to liquidate the company. If you liquidate the company, what happens? You get the value of the assets or whatever you get in liquidation. You pay me off as the lender, you get whatever's left over. So if you think about the claim here, the face value of the debt becomes equivalent to the strike price, because if you think about the option as a liquidation option, you liquidate, you pay off the face value of the debt. If the value of the firm exceeds the face value of the debt, you get that difference as the equity investors. If it's less, the most you can lose is what you originally paid for the equity. Equity in a publicly traded firm is essentially a call option if you think about the liquidation as the strike feature, as the exercise of the option. Sounds like a very strange view of equity, right? Because most of us, when we buy shares in companies, buy it for different reasons. You buy shares in Con Ed. What are we buying it for? Well, you can help me on this one.
What was the stability of the growth that company had?
Or more, I just want to get the dividend in my pocket, right? Forget about the stability and the growth. You get the dividend check. It's like buying a bond. I buy it for dividends. I don't buy it for a liquidation option. I buy shares in Microsoft. Why am I doing it? Because of dreams. They have AI and how it's going to turn out and grow. Most companies, in fact, the discounted cash flow view of the world is to value the company as a going concern. It's I'm buying a share of the going concern. But if you bought shares in Bed Bath and Beyond today, are you buying it for the dividends? I hope not. There's not going to be no dividends. You're buying it as a going concern? What going concern? So why are you buying it? For the same reasons you buy a deep out of the money option. You hope that something good will happen. You pray that something good will happen. And most of the time, nothing good happens. So you take the 35 cents you paid per share, you drop it in the trash can. Sounds like a crazy reason to buy, right? So what are you hoping for? That something, some event will come around and turn the company around, and the 35 cents will become $2. It's not becoming a healthy company, but it's becoming a less bankrupt company. You buy it for the same reasons you buy deep out of the money options. That's why I said this approach to thinking about valuation works if you have a troubled company with a lot of debt. Because essentially what you're hoping for is something will move the value. Don't think too hard about where you'll find it. You buy any airline, you are buying an option for the most part, right? There are very few healthy going concern valuations of airlines. Maybe a Southwest at its peak you might have bought. Other airlines are in and out of bankruptcy all the time. Yes, Ed.
Unlike a normal option, in practice, you don't exercise it when you want, right?
You can, right? You choose to, but the thing is you'll wait and you wait and you wait because time is your ally. So unlike other real options where you get early exercise, here you're going to let it play for as long as you want. But there can be forced exercise, which is when the interest payments come due. So that's something you got to build into the model is you control the action until you don't. So the first example I'm going to set is going to show you how I deal with this. I'm going to give you a very simplistic case of a company. It's a company that right now is a value of 100 million. So you value the operating assets. Think of that as a DCF value of the operating assets, 100 million. But you're uncertain about that value. So there's a standard deviation of 40% of the value. So 100 million is the existing value, standard deviation of 40%. This company has one nice 10-year zero coupon bond. And you're going to see in a minute why I've constructed it this way, is to give you as the equity investor maximum power. A 10-year zero coupon bond with a face value of 80 million. So I've given you the value of the company, the standard deviation of the value, one zero coupon bond with an $80 million face value, and the 10-year bond rate is 10%. I'm going to argue that very, very limited information. You should be able to tell me how much the equity in this company is worth. And you should be able to tell me what interest rate you would charge on the debt. I haven't given you betas, cost of capital, cash flows. What did I say you guys have? You have an option on the company, right? It's valued as an option. What's the underlying asset? It's a firm with a value of 100 million. So S is going to become the 100 million because that's the value of the underlying company. What's the strike price? If you liquidate, what do you have to pay out? The 80 million that you have due on the zero coupon bond. That becomes the strike price. How long do you have the power to run the business? Until the debt comes due. Now you can see why I made it a nice zero coupon bond. For the next 9 years and 364 days, all the bank can do is complain, but not much more. So you got a 10-year option. The variance in firm value, that 40% squared is 0.16, and the riskless rate is 10%. SK, N of D1, N of D2. I'll come back and talk about the N of D2 because there's a very clear meaning to this N of D2 here. But you plug in the numbers, the value that I get for the call is 75.94 million. Saying, what does that even mean? The equity is a call option. The company, it's worth 75.94 million. What's the total value of the firm? 100 million. If 75.94 million is equity, the remaining 24.06 million is debt. Remember, it's a zero coupon bond. So 80 million is due in 10 years. The value today is 24.06. I solve for the interest rate. I get an interest rate of 12.77%, a default spread of 2.77%. It's a very, very skewed perspective on equity, but you can see in troubled companies how it gives you focus in your equity. You're buying a call option on the equity, and that call option has a value of 75.94. The rest has to be debt. You go back to the N of D2. Do you remember what the intuitive meaning we put on N of D2? What does it measure? The likelihood that this option will be in the money, right? There's a 63% chance that the value of the firm will be greater than the debt outstanding, which means there's a 37% chance of bankruptcy. There's an outfit called KMV. It's a West Coast-based outfit that has used option pricing models to estimate default probabilities for companies' loan portfolios. They use an option pricing model. They take the ND2, that then becomes 1 minus ND2 becomes the probability of default. So 63% chance the company will make it, and my equity is worth 75.94 million. So let's say you look at this analysis, you buy into my analysis, you buy the equity for 75.94 million. I'm going to use that now to ask some what if questions. What if tomorrow you woke up to a catastrophic news story? Half your company has disappeared and it's not insured. What is the value until yesterday? 100 million. The value of the firm has now become 50 million. Unless you have a very perverse definition of good news, this is not good news for you as an equity investor, right? So your equity yesterday was worth 75.94 million. It's clearly going to be worth less today. So I have a very simple question. How much less will the value of equity be? And here are your choices. Value of the firm drops by 50. You can take 50 out of the value of the equity. 75.94 minus 50 would give me 25.94. Or maybe it'll drop by more than 50 million because your accountants are going to tell you the book value of equity is negative now. Or it could drop by less than 50 million. So 3 choices. It'll drop by 50 million, less than 50 million, more than 50 million. Which one of those do you think is the most likely outcome?
More than 25.
You think it'll drop by more than 50 million?
Yeah, the company we work with.
Okay, it'll drop by less than 50 million, in which case somebody else has to bear the pain, right? Who's the only other player to bear the pain? The bondholders. Will they want to bear the pain? No, but I'll drag them in anyway. You say, I don't want to be part of this. No, too late. In fact, here's what I did. I took my option pricing model and replaced only one input, right? I still have the same debt outstanding. The standard deviation stays the same. It's a business, it's half the business, the percentage standard deviation, but I replaced the 100 million with the 50 million. I value the option, and what I get as the value of my equity is 30.44. It's absolutely right. My value dropped by 45.5 million, but by only 45.5 million. Who's the other player in the game? The debt holder dropped 4.5 million. And if I solve for an interest rate now, it's going to be 14.5 or 15%. But take a look at ND2. It was, remember, it was this number was 63% before this happened. It's now 42%. The chance of bankruptcy went from 37% to 58%. Effectively, when company value drops, you're going to get this redistribution of wealth happen as well between equity investors and lenders, which means you can't go directly. From value drops 50 million, your equity won't drop by 50 million as well. Once I got started on this, I could not stop myself. I wanted to see when equity would become worthless. So I remember I went from 100 to 50, equities still hanging in there. I made it 40, then I made it 30, then I made it 20, then I made it 10. I could not make the equity value go away. I made the value of the business 5 million. And it's a basket case company, right? It has an $80 million zero coupon bond outstanding. What's keeping the equity afloat here?
Variance.
Time and variance, right? You need both as your ally. You got 10 years and you say, please God, let something good happen in the next 10 years. This is why deeply troubled companies often continue. It puzzles people. Why would people buy shares in Bed Bath & Beyond? Everybody knows it's a basket case. You're absolutely right. They're not buying it for the same reasons you buy Con Ed, you buy Facebook. You're buying it for this liquidation option. Yes.
The event
Then I think, flesh me out, if there are a 10-year coupon bond, what's going to happen to this option? You have 10 one-year options. So the structure of thinking stays the same. It just means that you have a one-year call option followed by another. It's actually a very messy set of options because each option's value is a function of whether the previous option stays alive. It can be done. So the thought process stays the same. It just gets a lot messier when you have 10-year. I'm going to give you a simplistic way of getting around that. But you're right, this 10-year zero coupon is a complete artifact, right? What troubled company has one nice zero coupon 10-year bond outstanding or 8-year bond outstanding? It does make the thinking cleaner here because it keeps that issue off. But if you have a regular 10-year bond, think of it as a series of one-year options. Yes.
So companies with very high betas would be good candidates for
High standard deviation, because remember, betas measure only market risk. So you now want to go to total risk because everything that causes the company to move now becomes part of it. And that actually is an interesting thing. If you're going to buy equity in a troubled company, don't make it a nice, safe troubled company. I don't even know what that means. But if a company says, look, I can guarantee you I will lose 100 million every year for the next 10 years, this is not a good candidate. You want to put your equity in deeply troubled, risky companies, because that's the only way you get out from underwater to above water is you would need a huge volatility in firm value to come about. Yes. Absolutely. Commercial real estate, I think, operates like an option. When real estate prices drop, people will swoop in and buy the equity for fractions, and often they will have to write it off if equity doesn't pick up. But I mean, that optionality kicks in anytime you have a highly levered business where the value, I mean, historically, real estate values have not been that volatile, but the more volatile they get, that leverage is going to have that optionality kick in. But it does mean that if you lend money to a levered firm, for God's sake, protect your interests, because as the equity investor in the firm, I can take advantage of you. In fact, I'm going to use this to kind of illustrate how conflicts of interest can play out. You got a value of equity. Remember, so let's go back pre-catastrophe. Here's the value of equity, 75.94 million. So I'm going to come to you with a project. You're the manager of the firm. You cater to the equity investors. I come to you with a project. And I want to sell you the project. So I start by describing the project. It's a negative net present value of -2 million. What's your first reaction? Get out of here. I said, no, wait, but it's a negative net present value project, which has a huge amount of risk. This is going from bad to worse, right? In fact, if you take this project, the standard deviation of your company will go from 40% to 50%. So I want you to take a bad, risky project. This violates every precept in corporate finance, right? What do you think will happen to the value of equity in this company if I take this project? Sounds like it should go down. Terrible, risky project. Well, I decided to check it out. I took the value of the firm, 100 million, taking the negative net present value project will lower the 100 million to 98 million. So they think this is bad news. I still have the 80 million in debt outstanding. I've now increased the standard deviation to 50%. So 0.5 squared is 0.25, and the riskless rate is still 10%. You remember what the value of equity was before I took this bad, risky project? This is magic. It was 75.94. It's now gone to 77.71. But it's not quite. I've just stolen enough money from my bondholders to cover the negative net present value and make things worse. Don't feel sorry for the lenders. In this case, the warning sign I get as a lender is when you lend money to a highly levered firm, you have to assume they can rip you off. You got to put in protections, which means that project that comes up, you have to have a lender's representative sitting in there with the veto power saying, no, you cannot take that risky project because you're ripping us off. I'm always amazed at banks that lend money on LBOs as passive lenders. I mean, what possesses you to think that this is going to work out in your best interest? What's good for equity investors and what's good for lenders doesn't converge. And this is a classic way of illustrating how the two can diverge. Yes, sir.
I was like the CEO's stock options, a version of this, where the more risky the company comes.
That's part of the problem. In fact, did everybody get the point, which is, remember when people were given options and they were told this will match incentives up? It doesn't quite, right? because options are driven not just by the value of the stock, but the variance in that value. Whereas you as a shareholder want a nice stable value. So that can actually induce CEOs to take riskier investments than they should because they can benefit from the risk with their option holdings. That's why I'm glad that we've shifted away as much as we have from management options, restricted stock. You don't have that clash anymore. But anytime you talk about options, risk switches from being a bad to a good, and that can alter the way you make decisions. Yes, Lisa.
This was against the residual claim.
It's a residual claim and the limited liability. That's what's making you so daring, right? You know, if you're underwater, does it matter whether you drown in 16 feet of water or 35 feet of water? That's basically it. I mean, no Bed Bath & Beyond CEO saying, let me take the cautious view here. They're going to put everything on the table because what do they have to lose? They're going to go bankrupt anyway. This just means there's some chance, a small chance of making it out of there. So it's a residual claim and the limited liability that essentially makes equity investors take bigger and bigger risk because you have less and less to lose the further you get towards zero. Okay? And that's why with very highly levered companies, you got to be careful about incentives because what's good for the equity investors there can definitely not be good for the rest of the players in the game who've supplied 90% of the capital. Now that we're breaking traditional corporate finance rules, because now we said take negative net present value projects, let's stay on that theme. Let's assume you're manager of a company. Today, we're going to talk about acquisitions. So so the firm that we just valued, 75.94 million equity, decides to buy another firm, which is valued at 150 million. They pay a fair value. What's the conventional wisdom of what will happen to your stock price when you pay fair value? Nothing should change, right? Zero net present value. Let's see if that's in fact true by playing this out. So there's firm A that we just valued. There's firm B that you're acquiring at fair value. The two have standard deviations that are different. They're different businesses. Remember, though, what happens to the firm when you combine it, right? If they're different businesses, you get that variance in a portfolio equation. So this looks foreign. It's just the two asset portfolio. So you now have two companies and two businesses coming together. The combined company is going to be safer for the simple reason you've removed some of the firm specific risk. That's going to have consequences. You make the combined company safer. If you think about the two players in the game, equity and debt, who wins and who loses? The debt holders win when you have a safer company, and equity investors lose when you have a safer company from the options perspective. So here's how it plays out. 75.94 million was the value of the equity in firm A. 134.47 million was value of equity in firm B, fairly valued. The combined company, the value of equity I get is about $3 million lower. And that's a direct consequence, again, of a transfer of wealth away from equity investors to lenders. So this is the flip side of what we saw in the previous section. You're a conglomerate, you keep buying other companies and other businesses. And if you keep the existing lenders essentially protected, they're going to gain because you're creating a safer company. And they now have interest rates that were set based upon a riskier businesses that'll give them a benefit. Is there a way you can claw back some of those benefits? If you're the manager of this company and you're on this conglomerate bench, what are the two ways you can claw back some of this wealth distribution? Ed?
Restructure the debt.
One is borrow more money, right? When you do acquisitions, borrow more money, that effectively would do it. The other is go into the lenders and essentially ask them, look, this is a safer company. I know. And if they refuse, remember, much of US debt can be repaid in advance, right? There's no restrictions in repaying in advance. You repay that debt, replace it with new debt at a lower interest rate. But if you don't watch that wealth transfer, you can very quickly see it's not big. So you don't even notice it seeps away with each acquisition. So you can see the construct for valuing equity. But as you point out, I made a lot of very simplistic assumptions to get there. I gave you the value of the firm. You're saying, where the heck am I going to start with that 100 million? I gave you the standard deviation of value. You're saying, I don't know where I'd get that either. I made it one nice zero coupon bond when in effect you have dozens and dozens of debt with different maturities and different interest rates. So I'm going to try to squeeze real world companies through this model, and I'm going to make some pragmatic assumptions to get there. So here's what I'm going to do to get the value of the firm. I'm going to use my DCF valuation. And you already actually have it. So if any of you have troubled companies, you've done the bulk of the value. The DCF value you get for the operating assets becomes the S in the model. That's the value of a company as a going concern. If you don't have time to do a discounted cash flow valuation, you can do a liquidation valuation. If I sold the pieces or a pricing, that becomes the S in the model. What would I get if I liquidated the company today? For the variance in that value, if your company is publicly traded, you have two numbers out there you can use to come up with the variance in value. You can use the standard deviation of the stock price that gives you the variance in equity value, but you'd also need a bond price variance because it's a variance in firm value rather than just the equity value. That's going to be a mess. So I'm going to give you a shortcut that I'd use almost every single time. Remember how we got bottom-up betas? Where we looked at ours. I compute bottom-up standard deviations in value by sector. So if you gave me a troubled steel company, rather than me going getting the stock price of the steel company, the bond price, and playing this little gymnastics game of what the standard deviation value would be, I go to the standard deviation of steel companies and firm value and use that as my standard deviation. Saves you a lot of time and actually gives you a better estimate because you're not using this, these equities that might be incredibly volatile because of the danger the companies in. For the value of the debt, here's where I'm going to cheat. I'm going to take all of your debt outstanding. I'm going to gather it all into one big lump sum. 1 year debt, 3 year debt, 5 year debt. And then I'm going to take a weighted average, if I can, the durations of each of the debt. But if I'm in a hurry, the weighted average maturity and come up with a way. You see what I'm trying to do, right? I'm going to try to take all of your messy debt and replace it with one equivalent zero coupon bond. Cheating? Absolutely. The alternatives are too terrifying in terms of the option pricing challenges I will face. So that's going to give me pretty much everything I need for a real company that will allow me to apply the option pricing model. So I'm going to apply this on a company. It's an old example. I should probably update it with one of the airlines today. It's a valuation I did of Eurotunnel. You heard of Eurotunnel? It's a tunnel in the ground where cash goes in but never seems to come out. Essentially connecting England and France. So it was built with the best of hopes that this would somehow make money. Okay? So I did a valuation. So at the time that I valued Eurotunnel, I first wanted to make sure it meet the criteria for an option pricing model. First, it was losing money. It was losing lots and lots of money. And it lost so much money that its book value of equity had turned negative. So that's a sign that it's not just losing money for 1 year, it's been losing money for a long time. So it's a money loser with a long history. So 1/2 of my requirements are met. It had almost $9 billion in debt outstanding. And it's spread out all over the place. It was not a nice zero coupon bond. So the distribution of debt, there's the debt type, there's the face value of the debt. I computed the duration. But as I said, if you use the maturity, it's not a big deal. So it's a money losing company. It's continuing to lose money. It has a huge amount of debt. I know an option pricing model is going to help me here. So first thing I did was I closed off my eyes to the option pricing model, did a traditional discounted cash flow valuation. And I built in the usual way you deal with a money-losing company. I fixed the margins over time, no recovery built in. The value that I got was $2.3 billion. What's the outstanding debt? Remind me again. $9 billion. My discounted cash flow valuation of the company, assuming it makes it back to health, is $2.3 billion. This is a deep out-of-the-money option. One final input, I need a variance in firm value here. Because Eurotunnel was so unique in 1997, I didn't have the luxury of doing an industry average. Today I would use infrastructure companies and use their. So in 1997, I actually looked up the stock standard deviation in Eurotunnel's stock price, which is 41%, and Eurotunnel's bond price, which is 17%. So basically I looked at the traded shares and bonds. If that equation again looks weird, it's just a weight because I'm now creating a portfolio composed of 15% Eurotunnel equity and 85% Eurotunnel bonds. That was the debt ratio. The standard deviation I get in firm value is 0.0335. The 15-year bond rate was about 6%, which works out to the duration of a 15-year bond is roughly 11 years, which works out to be the weighted duration of the debt that I have. I have everything I need. There's the value of my underlying asset, $2.3 billion. Face value of my debt, $8.9 billion. Deep out of the money option, but I knew that was coming. One advantage I have is the debt is really, really long-term. So even though I have some short-term debt, the bulk of the debt is long-term. I have 10.93 years to play this game. Maybe the Sultan of Brunei will say, I like a tunnel. Will you name it after me and pay 4 times? As I said, it's built on a hope and a prayer that somebody will come along or something is going to change fundamentally. What's the likelihood of default here? 92.5%. There's a set. Look at the ND1. ND2 is always, so there's a 7.5% chance that the company will make it back above value, which means there's a 92.5% chance. No surprise again, right? You looked at the debt, you saw that was coming. But here's the miracle. Everybody agrees it's a deeply distressed company. This is, in fact, the perfect prototype for a basket case company. Miracle of options, the value of the equity is 122 million. Why am I paying 122 million? Because I have 10.93 years where something good can happen. And if that happens, who knows what the value of equity could become. So as you watch airlines go in and out of bankruptcy, and you watch their shares continue to trade even as they're bankrupt. I mean, you could have bought Continental Airlines shares in 1993 for 23 cents a share. 3 years later, it was worth $52 per share. That's the kind of payoff. So if you buy a lot of troubled companies and 90% of the companies, what's going to happen? You're going to lose what you paid for the company. It's a very skewed distribution. The 6 or the 7 or the 8% of your companies that actually come back deliver such huge returns that they hopefully make up for the. So it's called vulture investing. Basically, and other people have done this well, where you focus in on troubled companies, you buy a portfolio of troubled companies, and then you hope that the winners carry your entire portfolio. And
Why wouldn't you just buy a call option?
on your turn,
Yeah.
because call options run out in 3 months or 6 months, right? You need time. If you were able to buy long-term call options on these, you could. Unfortunately, these are exactly the kinds of companies where you're not going to get long-term call options or leaps. But it's a mindset that basically, again, even if you never apply an option pricing model to value equity in a company, I want you to think about that line that gets crossed when a company goes from being viewed as a going concern to being treated as an option. It's a big change, right? Because then you're betting on risk becoming your ally rather than your enemy. Everything starts to shift in terms of how you think about investing and valuing those companies. And I said, brick and mortar retail. If you go past the top 5 or 6 healthy names, right? Target, Walmart, and you go below that, you're looking at basically options. Airlines, 90% of airlines around the world are essentially you're buying options. You're not buying them for the same reasons. And for some of you valuing troubled companies, you have trouble getting your DCF value to exceed your debt and say, what do I do? This might be your last shot of actually getting a positive value for equity. Is it's trading as an option? Any questions? So I want to start on acquisitions. And now the title kind of gives away what I think about acquisitions. About 20 years ago, an old student of mine ended up setting up this executive seminar series. That was his business. He ran executive seminars. So he ran an executive seminar for CFOs of serial acquirers. For like, these are companies that do acquisitions every month, like a book of the month club. They do an acquisition of the month. See, we gathered them together in New York, and he calls me and he says, would you be willing to come and talk to this group? And I said, are you sure you got the right guy? You know what I think about acquisitions, right? He said, no, I know exactly where you're going to come from, but for the rest of the day, they're going to hear from bankers. You know what bankers think about acquisitions, right? It's the mother's milk of all deal making. It's always great. And he said, you can be the antidote. And I said, give me the last 30 minutes and I'll do it. And I'm going to give you the session that I gave these acquirers, because I made these CFOs a deal. I said, look, I'm going to take you through a series of 7 very basic fundamental tests on acquisitions. And if you fail on more than 2 of the tests, I'd like you to stop doing acquisitions. None of them took me up on the deal. But for those, any of you planning to be in M&A? Up to you. Okay. So Lisa can be one of the candidates for the 7 level test. And if you fail more than 2, would you be willing to switch jobs and go into something else? Probably not, right? So don't make it explicit. You can always change your answer and make it right if you get the wrong answer. So let's start by setting the table. There are 2 players in an acquisition. There's the acquiring firm and there's the target firm. I know all the attention goes on the acquiring firm, pay attention, but the reality is there's just as much action happening in the target firm. So one of the things you can look at is what the stock prices of acquiring and target firms do around the date of the acquisition. And this shouldn't come as a surprise. On the date of the acquisition, there's one group that's very happy. It's shareholders in the target firm. And the other group, which is always feeling a little mixed about what just happened, because on average, at least, acquiring firm shareholders don't seem to share the spoils. The game seems tilted in favor of target company shareholders. This is public to public companies. We'll talk about public to public companies. If there's a winner in the game, it's clearly the shareholders of the target company. It's not shareholders of the acquiring company. Now, of course, if you ask the managers of the acquiring company about this, what's their response? Because they were supposed to take care of their shareholders, right? Their response is the market doesn't see what we see. We have access to details. We've done this research. And part of that is true, right? Managers do know more about the insides of the acquisition than shareholders do, but they're one fatal flaw, which is they're incapable of being objective. You're part of a deal, it becomes very difficult for you. It's got nothing to do with being dishonest. You convince yourself there is synergy. You convince yourself because you've been spending so much time in the deal that no. So if you ask them, they just say, just wait, because if managers are right, what should happen? 5 years later, when you look at these deals, the acquiring company should have gained, you should have seen an increase in value. And if you look at the evidence on post-acquisition results, so these are studies that McKinsey does, KPMG does, following up 5 years or 10 years after the deal, McKinsey actually asked very simple questions. Did the return on capital invested in the acquisition exceed the cost of capital? That question sound familiar? It's a question we've been asking all through about any project. That should be true about big deals as well. Did the acquisitions help the parent companies outperform the peer group? Because you're telling me that there's some synergy, it should show up in outperformance. Half of all the programs they look at fail at least when, and many fail both tests. So that is a very early McKinsey study. KPMG in the 1990s did a study where they looked at almost 6,000 acquisitions around the world with a singular question. That one word, synergy, that keeps getting used over and over. What percentage of mergers actually deliver on synergy? Because the combined firm's earnings should go up relative to the standalone firms. And they found that 1 in 6 mergers deliver synergy. About 2 in 6 deliver nothing, which leaves a half of companies where they actually found negative synergy. We say, what's negative synergy? 2 companies come together. The combined company somehow manages to underperform the 2 companies standing alone. So much promised benefit from synergy doesn't seem to manifest. So looking both at the day of the acquisition and after the merger, there is very little evidence that doing acquisitions actually benefit shareholders of acquiring companies. And I have bad news, the disease is spreading. What do I mean by this? Most of these studies are of US companies. But in the 20, 30, 40 years ago, if you looked at target companies, you had acquiring companies in developed markets, target companies were in emerging markets. So Indian companies, Chinese companies are usually target companies. The worm is turned, right? Now you have Indian companies acquiring UK companies or US companies. And when you look at those companies, you seem to see the same kind of evidence you saw with US acquirers play out. When you look at Chinese acquirers, Indian acquirers, there's something fundamentally wrong here. Because it replicates across markets, across acquisitions. So one of the questions, of course, is this the process by which we do acquisition? Is there a flaw in the process? And there clearly is, right? In much of the world, how do acquisitions work? You're an acquiring company, there's a target company, both hire bankers, and then the rest is lost, right? Because those bankers have one objective, which is what? To get the deal done. And it's not because they're bad people. That's how they get paid, right? That's the way we've set up the incentive structure. Because if one of the bankers comes to you and says, don't do this deal, it doesn't make sense, they get nothing. So we've created a process that's going to make it more likely that bad deals go through or any deal goes through once the deal process gets started. So if we look at the collective evidence, the target companies pay too much, they don't get the benefits they claim to get, there's something wrong with the process. Now, what I'd like to do is talk about how that skewed process plays out in bad choices when it comes to valuation. I would never teach an M&A class because I'd run out of stuff to say after session one, right? It's because to me, I'm not interested in the deal-making part because I'm not that good at it and I don't care much about it. To me, the essence of an acquisition is a good acquisition is one where you pay less than what you get back as value. A bad acquisition is one where you pay too much. So let's talk about the structural causes for why acquisitions historically have had such trouble delivering value. And these are the 7 tests. So Lisa, be ready because the tests are going to come at you. First test is what I call risk transference. Acquiring company, target company, what discount rate should you use? We've talked about this already. We'll talk about how risk transference is a big factor in why bad acquisitions go through. Second is what I call the debt subsidy game, which is when you compute the cost of capital used on an acquisition, you use the acquiring company's cost of debt. You're already loading the dice in favor of the target company shareholders if they're risky, if the target company is a risky company. So we'll see how that plays out. The third is this magical word control. Remember the first session, I held up the word control and we talked about 20%. I wasn't being facetious. It's amazing how people add percentages to prices for control without a clear sense of what exactly control is and what they're paying. Then I want to zero in on the word synergy. After all, it's a one big word in acquisitions. And if your question is, can synergy be valued? It better be valued because you just paid for it. If you're paying for something and you tell me you can't value it, we're in deep trouble. So we're going to talk about how to value synergy and what types of synergy are more likely to deliver value. So different kinds of synergy. Fifth is, like everything else, M&A is about pricing. And often pricing is based on a multiple and comparables. You're saying what's different about M&A. I think the M&A pricing process is even more screwed up than the typical pricing process because the way in which we come up with comparables and the multiples we end up using. Sixth, and I think this is a big factor, like before we blame the bankers, we have to recognize that when CEOs of companies go to a banker and say, should I do this deal? They're not asking for advice. It's like that old Jack Nicholson movie, right? You see A Few Good Men. He's on the stand and he's asked, what is, you don't care. I mean, what do you say? You don't want to hear the truth. I don't remember the exact words. I saw Jack Nicholson on the Lakers sidelines yesterday. Man is old now. So, but we're all getting older as well. But no, but many cases, CEOs don't want to hear the truth. They don't want to hear that the deal doesn't make sense. They want affirmation. So before we blame bankers for all the bad stuff, we don't talk about CEO egos and how they drive some bad deals. And finally, I think that to me, the most troubling part of the M&A process is how nobody seems to be held accountable when a deal falls apart or deal goes bad and you lose billions of dollars. You take a bad project and lose 50 million, you get fired. You do a bad acquisition, you cost 50 billion, you get promoted. It seems it's a very strange process. So I think all of those come into play. So you can keep tabs for yourself. I won't check on you as we go through each test as to whether you're passing the test, because by now you have all the ammunition to need to ask the right valuation questions and make the right valuation judgments. Yes.
What if the acquiring firm actually pays less than the share price?
How would you do an acquisition? Tell me in transaction terms how you pull that off, right? Stock is at 50. I try to buy your shares at 45. Who's going to tender their shares? That's different. Though. Credit Suisse, the stock price was already done, right? By the time the actual transaction happened, there was no stock price. Like today, there's no First Republic stock price. It would have been zero today, right? So I think that's you can never do a transaction at below the stock price. In this case, these are not traditional mergers. JP Morgan is not doing a traditional acquisition of First Republic. It's picking up pieces. We don't even know what the specifics of the deal are. And for the moment, we have no idea whether this is a good deal or a bad deal for JP Morgan shareholders. My guess is that they will walk away with the good deal and leave the leave the residue for somebody else to pick up, probably taxpayers to pick up. But we'll see. No. So let's try each of these tests. So it's today you notice there was no start of the class test because today's class is all going to be a series of tests, and I'm going to keep the numbers simple. Yeah. So You're an acquiring firm. I come to you with a target firm. Let's keep the target firm very simple. It's got revenues of 100 million, operating expenses of 80 million, operating income of 20 million, after tax operating income of 12 million. I'm going to assume this company has zero growth in perpetuity. What does it get you when you have zero growth? You don't have to reinvest money. So your after-tax operating income becomes your free cash for the firm. I'm trying to keep things simple so you're not doing a reinvestment rate. So your cash flows every year are going to be 12 million a year, right? So your depreciation, CapEx, all of that kind of goes to zero. So you get 12 million in cash flows every year in perpetuity. Let's say the cost of equity for this company is 20%. It's all equity funding. So you got 12 million in cash flows every year in perpetuity. Your cost of equity is 20%. What's the value of this company? Forget about the acquisition part of the product. We haven't even come to that. What's the value of this company? 60 million, right? 12 million divided by 0.2, 60 million. File that away because I'm now going to try to convince you to pay more than 60 million. That's my job in an acquisition, to convince you to pay. So here's my first try. I said, look, you're a safer business. Your cost of equity is only 10%. You see where I'm going to take you, right? What am I trying to get you to do? Take the 12 million and use your company's cost of equity of 10%, which will make the value of the target firm magically 120 million. Acquiring company's cost of equity, or a safe company, will push up the value of the target company. For all the wrong reasons. The target company didn't become more valuable. You've effectively subsidized the target company by applying your cost of equity to the target company. So when you think about looking at target companies, is the point I made earlier with the Congolium example, it's always the target company's risk characteristic that should drive the discount rate for the target company, rather than the acquiring companies. Because if you use the acquiring company's cost of equity, you can see how this is going to play out. It's going to play out like AT&T in the 1990s, where they kept buying technology company after technology company because they kept looking cheap to AT&T. You know why they look cheap, right? AT&T had a really low cost of equity. They would take a software company which had twice the cost of equity. That looks amazing. That looks amazing. That looks amazing. And after all these amazing deals, AT&T was almost bankrupt. So how did that happen? GE did a variant of the same thing, where they applied GE's cost of capital to acquisition after acquisition without factoring in that they were buying. And you're saying, won't the mistakes average out? They won't, right? Because they're always going to cut in one direction. Because when you try to value a safer company to your cost of equity, you're going to find that they're unreachable. All the riskier companies are going to look cheap to you. That's risk subsidization. Yes.
Berkshire Hathaway.
Berkshire Hathaway doesn't do first a lot of acquisitions. Many of them are smaller companies. Most of their investments are in publicly traded companies as just holdings, right? So 90% of Berkshire's value doesn't come from buying See's Candy, or it comes from their holdings, Coca-Cola and the Washington Post. So the bulk of Berkshire Hathaway is in publicly traded companies. In the private businesses that they buy, they're often private business. They're not publicly traded companies. So their acquisitions often are very specific types of companies that go into it, and they tend to be safe companies. You're not buying risky businesses. So if they're screwing up by using their cost of capital, the range of mistakes you can make tend to get smaller because you stay with mature, safer businesses. Okay. So if they're screwing up, it's on some other dimension. It's not on this one. So everybody comfortable with that notion? Because Lisa, you're going to have to fight this fight, because when you get out there in M&A, it's amazing how often the acquiring company's cost of equity and cost of capital will get used in valuation. And you have to be able to explain the consequences of doing this over time, because that's the only way you get it, because otherwise it's just one deal. In fact, GE's argument, I actually, was at GE's headquarters a long time ago when they were actually a healthy company and had a headquarters. Do they have one still? Maybe they do. So this was in Stamford. They come out, all the GE divisional heads are there. And I talk about M&A, and I did this session, and I get to the spot and I look at the room and I say, you guys don't do this, do you? They all look at each other and they say, we do, but it's okay here. I said, what do you mean it's okay here? They said, we're so big and they're so small, it probably doesn't make a difference. I said, if I took a Krispy Kreme donut and cut it into 24 pieces and ate all 24, how many calories do you think I'll get? You take 24 bad deals, you add them all up, it becomes one really bad deal, right? But they felt no qualms about saying, no, we use one cost of capital, we're a big company. So it's a fight that needs to be fought, because to me, it's one of the It's a cardinal sin in any kind of valuation. Yes, sir.
We know when private investor looks at a public company, their capital is different, they have less diversification. In this instance.
They'll drop out of the bargaining, right? So if I am if I'm bidding for a public company and there's a public bidder, I will never be able to pay the price they do. Where I thought you were going to look at the other side, which is if you have a private business which thinks of its cost of equity based on total beta, public company looking at the same company will see only, and that's one of the reasons why public companies acquiring private businesses remain a place where there's value to be gained on both sides, right? Because the seller is not diversified and the buyer is diversified, you can actually split the difference and walk away happy from the table. But if
In
you,
that instance, you're using your cost of capital.
it is always the same unlevered, it's always the target company's unlevered beta that I start with. The only difference is how I use the correlation to get up with it. So it's actually Alan lays the same point because it seemed like a violation of the rule of it's always the target company's carrying. It's still the target company, but the way you see the target company's risk is different depending on potential buyers. And that's what makes your private business valuation buyer specific. Let's talk about cost of debt. Let's say you as the acquiring company have access to really cheap debt. You're a highly rated company. You can borrow money after taxes at 4%. So let's have convinced you to use the target company's cost of equity of 20%. But now you plan to raise half the money to do the acquisition from debt. You're the acquiring company at 4%. You can see how this logic is going to drive you, right? What do we do in the cost of capital? We take ratio, debt and equity. So it looks like 50-50. And I know we're supposed to lever the beta and unlever it. So, but let's leave the cost of equity at 20%. I now have debt at 4%, 50-50. I'm going to end up with a cost of capital of 12% in the middle, right? And I put a 12% cost of capital, that $60 million company will become a $100 million company. Sounds pretty reasonable, right? I am borrowing money at a low rate. I'm able to borrow a lot of money. So why shouldn't I use that low cost of debt and that debt ratio in my cost of capital calculations? Yes.
The risk on the debt is not much risk of the target.
I'm giving a $40 million premium to the target company shareholders, right? Why? Because I have a high rating, which I earned by doing what? By running my company really carefully for the last 100 years. I am rewarding the target company shareholders for something that they had zero role in creating. I'm subsidizing. I know it sounds counterintuitive, but the fact that you can borrow a lot of money at a really low rate shouldn't allow you to pay a higher price for a target company, because then the target company shareholders are essentially reaping the benefits of something that they had absolutely no role in creating. You think, what can I do? Let's say the target company could actually borrow 20% on its own. They chose not to borrow money. Let's say they could have borrowed that money at 6%. Why? They're a risky company. I'm okay computing a cost of capital using that 20% debt ratio and the 6% cost of debt, because that would be a target company debt ratio. It wouldn't be something where I'm allowing the target company to get subsidized because it's part of GE. Think of GE at its peak, AAA rated company, able to borrow money at 3.5%, going around using that in cost of capital calculations to buy target companies that are much riskier, and you can see the subsidization play out over time. So not only should you use the target company's unlevered beta, levered beta for the cost of equity, you should also be careful that when you use debt ratios and a cost of capital to value target company, that those debt ratios are not artificially pushed up because you have access to debt at a really low cost. Any questions on the cost of debt? Let's talk about control premiums. That 20% that I threw out here, I'll give you the background for where the 20% comes from. There's actually a database called Mergestat that takes into account every acquisition that happens in the US. We have access to it, I think, as as you have access to it as MBA students. So it has every acquisition in the US. That 20% is actually the average premium or the median premium, as they say, that companies pay. So it's the price paid in an acquisition relative to the market price. So that's a premium that's propagated across all acquisitions. If I do that, what effectively am I doing on every acquisition? I'm assuming the average is right. that people don't overpay on average, that they pay, which actually cuts against what we started the session with, right? The acquisition generally overpriced. But even if I buy into the fact that acquisitions are correctly priced, remember that premium includes not just control, it includes synergy and all the other stuff. How the heck do you just take the entire premium and say that's control? And then on top of that, add synergy and all the other stuff. It's a recipe for double counting. So let's step back and think about what the true value of control is. I'll come back and talk more about this on Wednesday. Remember the target company had a 20% margin. So the operating margin was like, they were earning 20 million on $100 million revenue. Let's suppose you think you can run the target company better. Why? You think they're inefficient, that their equipment is old. You think that if you ran the company, the margin would be 30%. How would you value the target company? Just take the 20% margin, replace with 30%, 60 million will become 90 million, right? That 30 million is a value control. Would you pay the entire amount as a premium on the acquisition? If you did, you know what you've done, right? You've given the target company shareholders all the benefit for the hard work you're going to put in for cutting costs. So if this were a true acquisition, discussion or debate, and you wanted to preserve some of it, not only would you have to compute how much the value of synergy is, you then have to have a discussion of who gets what share of that, because somebody's bringing more to on the scale control. Who's doing the work? The problem, though, is if you end up in a bidding war, it's all control. I can almost predict where you're going to end up. You're going to end up at 90 million because they're going to play you off against each other. But control has nothing to do with two companies coming together. It's the fact that the target company is badly managed and badly run, and you're paying a premium because you think you can run the company better. Which also means that if the target company is perfectly managed and perfectly run, don't be paying any control premiums there. Because there's nothing to be changed by how that company is run. So I would argue in general, if you see rules of thumb in acquisitions, be very skeptical. Because these rules of thumb are created across hundreds of acquisitions across very different sectors. And the premiums reflect all kinds of factors going in, including stupidity. Because remember, when a company overpays, where does it go? It goes into that premium. So it's something that you need to think about whenever you see a rule of thumb of this is okay because. So don't use the acquiring company's cost of equity. Be careful not to subsidize the target company because you have cheap debt and access to debt. Be wary about control. I'm not saying don't pay for control, but if there is control, you have to start to become explicit. What costs am I going to cut? Is that feasible? And then play it out as a higher value. Let's at least set up the discussion of synergy. The essence of synergy is two companies come together and the combined company is able to do stuff that the individual companies could not have done as standalone companies. Let me repeat that again. Synergy is not just higher growth and higher earnings, because you can get that by just targeting running the target company better. It's something that the combined company can do that could not be done as standalone companies. So when you look at synergy, it has to either show up as higher cash flows for the combined company or a lower discount rate. And I'll make a statement, I'll try to back this up. Most of the time it has to be in the numerator. So when companies talk about having lower discount rates after the fact, I'm skeptical, and here's why. These were both publicly traded companies, right? You combine two publicly traded companies, there's really no benefits you get as investors from reducing risk, because you could have done it yourself. These two companies could have been in your portfolio, 50 other companies. So most of the synergy is going to show up in the cash flows. The question is, what form does it show up? So what I'd like to do, and actually with synergy, again, you got to ask the question, how much belongs to me? How much, because you're both needed for the synergy to show up. So I'll give you the big picture page of all of the different ways synergy can show up. Synergy, broadly speaking, can be either operating synergy or financial synergy. What's operating synergy? Operating synergy shows up as higher revenue growth, higher margins, cost cutting. So let's look at the different versions of operating synergy. Economies of scale. What kind of mergers you're most likely to see that? Two companies in the same business come together. The argument is there can be economies of scale. When InBev, the global brewery, bought Modelo, Mexican brewer, this is before the SAP merger, Their argument is we can come into Modelo, and because we're a big beer company, we can reduce their distribution costs, we can make the marketing costs go to zero. And it worked. They were able to actually cut operating expense by 30%. That's the easiest form of synergy to value because it's right now, it's concrete. You can show it as lower operating expenses, higher operating income valued right away. So economies of scale. The other type of operating synergies, I'm going to broadly classify as strategic synergies. Synergies show up as higher growth, a better return on investment in capital. So essentially, it's going to show up in your growth numbers. And here are the different ways it can show up. Maybe you can, as a combined company, earn higher returns on capital on your projects than you were able to as independent companies.
Isn't
Yes.
economies of scale benefit also result in higher return on capital?
Higher, it could, it could. So that could actually, but the question is it a one-time cut? In which case, you got to be careful that you don't build it in, is change in the marginal return on capital, but it could. That higher return on capital, if you can preserve it on new breweries that you build, will show up as higher return on capital and higher growth rate. You're right, it could provide double benefits to you. It could also show up as a higher reinvestment rate. Maybe by combining two companies, you're able to find more projects. A classic example is developed market brand name company buying an emerging market brand name company. We're saying, look, that's a big market. We can now sell both our products, much more reinvestment. It can also show up as barriers to entry that are much more difficult for competitors to get over. By combining these two companies, just don't let the Justice Department know that this is your rationale, because this is explicitly the reason that acquisitions get shut down. But implicitly, you might say, we'll become a stronger company that will allow us to earn higher returns for a longer period. In effect, I'm looking for numbers that I use in valuation all the time because I need to make it explicit. I would love to tell you that most of the synergies and mergers are operating synergies, but in my view, most of the synergies are financial synergies. And the most common financial synergy is a synergy that you never, ever mention in polite company, which is we're going to save taxes. I still remember in 2016, Pfizer came up with this convoluted way of buying Allergan, which is a UK-based company, because they wanted to switch their headquarters to the UK and escape what they felt at that time was a very unfair tax law in the US, where they would be taxed at the US tax rate on global income. And everybody knew this was driven by taxes. So Pfizer's CEO gets up on CNBC and he says, the primary reason for this is to save taxes. And my reaction was, are you out of your mind? Because you knew exactly what was coming right after that, like waving a red flag in front of the tax guy, say, come and get me. And every politician woke up the tax, and the deal actually broke down almost immediately. So if your primary reason is to save on taxes, you know what you should do, right? Use every weapon of mass distraction you have. Talk about strategic investments in China. That always helps. Or real options or artificial intelligence. Throw everything as a distraction when all you're saying is, I'm going to save on taxes. See, how can combining two companies save on taxes? It could be as simple as a money-making company buys a money-losing company in the average, though that's become more and more difficult over time. The IRS has become very clear on you can't combine two companies without meeting these criteria. But it could also be things like being able to write up the book value of assets, because you're sometimes allowed to do that, get more depreciation afterwards. And there are quirks in some countries' tax laws that actually benefit companies of acquisitions. I'll give you an example. In Brazil, you know how interest expenses are tax deductible, right? So about 30, 40 years ago, the Brazilian government decided, for the best of reasons, that they wanted to give equity an advantage to, a tax advantage. So in Brazil, you're allowed this line item called interest on capital. It's the strangest line item. When you look at it, what the heck is that? You're allowed to take your book equity and take a percentage of that book equity as a tax deduction. And the government will say 12%. So the number is specified by the government. So you see what you have an incentive to do, right? You want to make your book equity higher. For a long time, it explained why Brazil had the lowest price to book ratios of companies around the world. It's not because they were cheap, but because Brazilian companies, unlike the rest of the world, we have an incentive to lower book value and an incentive to push it up. You're saying, how does this help in mergers? The minute after you do a merger, you know what happens to your book values, right? They got inflated, especially because you're bringing in another company. So I'm going to use Ambev, which was the original Brazilian company that 3G Capital is in control of, and they bought when they bought Ambev, so the original merger. I was an Ambev shareholder. And I remember waiting for the benefits. It's great to be bought up in an acquisition because Ambev was the target company and one of the things that happened in that merger was that almost 80% of the synergy in that merger came from writing up interest on capital. It's the book value jump. I never got the benefits. You know why? Because I own the non-voting shares. They actually set up the deal in such a way that 80% of the premium paid in the merger went to the voting shareholders. And 20%. A reminder, if you needed one, as to why corporate governance matters and why not being able to vote makes a difference, especially when you have big transactions like this. So that's tax savings. There are two other potential financial synergies. In corporate finance, we talk about companies having optimal debt ratios, right? We compute it based on your earnings and your variance in earnings. Let's say if two companies which have optimal debt ratios 20% are at the optimal. Combining the two companies can sometimes push up your optimal debt ratio, especially if they're in different businesses, because you create a combined firm that's safer. Your optimal debt ratio might go from 20 to 30%. That increase in debt capacity is also a financial benefit. Again, it's a wealth transfer from taxpayers to a company, but you can see the debt ratios go up. And finally, with private companies, there is this benefit you get from just diversifying. Do you see why? You're a private company owner. What's your beta? You have a total beta, right? Which is the market beta divided by correlation. As you diversify, what happens to that correlation? It starts to move towards one. Which is one reason family group companies, if you look at them in Asia and Latin America, which have been around a long time, will be in every conceivable business. It was their way of dealing with this diversification risk before markets became accessible, is by being, public companies, it doesn't make sense. Private companies, it does. Yes. Well, I think technology companies come together. First, it's got to be a company in two different businesses. You get the greatest benefit, because think in terms of portfolio diversification, right? The lower the correlation between two companies, the greater the savings you're going to get by combining the two. So if you look at conglomerate mergers, which is where the most successful, you actually see the debt ratio rise. This is the kind of the counter to the option example. They'll actually push up their debt ratio as they get more and more diversified as conglomerates. So take some historic, like Gulf and Western, track them over time. Their debt ratio actually climbs as they go from one business to two businesses to three businesses, because effectively they become mutual funds at some point in time. So those are the potential synergies. So let's talk about valuing synergy in a merger. To value synergy in a merger, you got to go through 3 steps. First, you got to value the acquiring firm and the target firm as standalone entities. Let me repeat that again. You can never value synergy by just looking at the target company. It's impossible to do. So the next time a banker gets up and says, I valued synergy, and all they have is the target company. No, that's not the way it works. You have to value the acquiring company, the target company as standalone companies. Step 2, just add those 2 values up. You know what that's going to give you, right? It's going to give the value of the combined company if there's no synergy. If you just, because values are additive. Step 3, take the combined company and throw in every conceivable benefit that you think you can get. Cost savings, higher growth, lower cost of capital, higher debt ratio. Go to town with it. Take the combined company. And if you're right, what should happen in step 3, what you get as the value of the combined company should be greater than what you got in step 2, which is the value of the 2 companies standing alone. That difference is the value of synergy. And it also allows you to ask the question, what if I have to wait 3 years or 5 years for synergy to show up? You can see why that can happen, right? You combine 2 companies, it can take a while to integrate. You can take the present. So you have the mechanics for value synergy. So let's take a couple of examples of synergy so you can see this play out. About 20 years ago, Procter & Gamble, at that time, the largest consumer product company in the world, bought Gillette, 6th largest, huge consumer product. It was driven primarily by talk of synergy. So I decided I wanted to value synergy in this deal. So I'm going to keep it simple. There's my Procter & Gamble valuation of equity. There's my Gillette valuation of equity. I value them as standalone companies. 221 billion, about 60 billion. What's the value of the combined company? I'm going to call it Piglet. That's not the Procter & Gamble Gillette. They actually decided to continue to, I don't know why, keep the name Procter & Gamble. But I thought Piglet would have been a good name to pick after that. If there were no synergy, the value of the combined companies should just be the values of the 2 companies put together. I did a best case valuation of Synergy. You know why I call it the best case? I took everything managers said they would do after the merger, assumed they would do it, and they would do it instantaneously. Every single part of it is extremely optimistic. So they said they could cut operating expense by 250 million. Okay, I believe you. Next year, your expenses are down 250 million. They talked about a slightly higher growth rate, and they gave like, it had to be a few basis points. So largest and the sixth largest, you're not going to get a 20% jump in growth rate. So with the lower operating expenses, the slightly higher growth rate, the value that I got for the combined firm was 298 billion. There's a canard that we don't think Synergy has value. That's not the case. Synergy can have huge value. But here's the catch. What do I need to compare that Synergy to decide if the deal is a good deal for Procter & Gamble shareholders?
Premium.
What did they pay as a premium? They paid a $25 billion premium. And this is why I think acquisitions fail. Because people tell these big stories about Synergy, but they don't want to value Synergy. They want to use it as a plug variable. Look, it can explain away what I paid. And if you do that, you're lost. The game is out of your hands because you're going to get into that negotiating table and you're going to keep pushing up the price, saying, we have Synergy, that can make up the difference. In fact, if you were a thoughtful banker and a banker who actually wanted a good deal, you'd need this 298 billion, the 17 billion in your pocket. And you're first trying to negotiate to get some of that 17 billion for yourself, your shareholders. And if the pricing gets too rich and it gets to 17 billion, you know what you need to be able to do? Walk away from the table. The most powerful tool you have to stop bad deals is being able to walk away from bad deals. It's easier said than done because you've invested. Think of how many weeks or months you've spent putting this deal together. You feel like a failure, right? All that wiped out, sunk costs. I've spent 2 years doing this deal. What's an extra 8 billion, especially if it's not your own money, right? And that becomes part of the problem is people don't want to walk away from the table. And if you don't want to walk away from the table, you're going to end up overpaying for deals. Take a second example, tax benefits. This was when, Zenith was on its last legs. Zenith has a long and storied history. There was a time when you bought a TV in the US, Zenith was on it, right? When was the last time you saw a new Zenith TV? I mean, at the time that I looked at Zenith for this particular example, the only thing that Zenith had of value was accumulated losses. It's kind of a sad story as a company. Look how many NOLs we can sell. So let's suppose that you're Best Buy and you're thinking of buying Zenith, and you're doing it for a very pragmatic reason. You're buying it because you want that NOL. You have no desire for the name Zenith, none of that fancy stuff. And the NOL they have is $2 billion. What's the value of buying an NOL? What does it do? It saves you taxes, right? So if your tax rate is 36%, and if you have enough income today to cover it, you take 36% of 2 billion, that's 720 million, and that is your value gain. But let's say only $500 million in operating income every year for the next 4 years. You still have the 2 billion losses, but now what will your tax benefits look like? It's going to be instead of 720 million right now, it's going to be 180 million a year, right? So there's a time value of money. What else do you have to worry about? The expected operating income is 500 million. You have no idea whether you'll actually make. It's one of the big questions in valuation is when you have NOLs that are spread out over time, what discount rate should you apply on those NOLs to bring them back to today? Remember the rule we came up with when we looked at the pharmaceutical company? You have a cash flow. You said, think about the risk you face in that cash flow to give you a sense of discount rate. What's the risk in your? I mean, you could argue either for a cost of capital, it's your operating income that could be volatile, or you could actually argue it's taxable income you have to worry about here, because remember, it's after interest expenses and use of cost of equity. And so you can have this debate about cost of equity capital, but at least you're having a debate about where's the risk coming from. The reason I bring this up, in a lot of M&A valuations on the street, I often see NOL stake and multiplied by the tax rate and treated as value today. And that's extraordinarily optimistic if you don't have the income to cover today, because you're ignoring both the time value of money and the risk that you might never be able to collect on that NOL. So don't pay for buzzwords. Synergy is a great sounding word. I think it can have immense amounts of value, but you need to push people on Synergy. Right? What synergy? Where is it going to show up? And they'll be incredibly evasive because their argument is it's uncertain, it's subjective, then pay in subjective dollars. Don't pay, if you pay real money and you're paying a $25 billion premium, you can't use it as subjective. I can't get my hands around it because you just paid 25 billion for that subjective. I can't get my hands around it. You got to force people to be explicit. You know what the benefit of that is? Remember, I told you that KPMG found that only 1 of 6 companies synergy shows up. They looked at the characteristics of those deals where synergy shows up. And one of the things they found in common across those companies, these were companies where plans for synergy were made before the acquisition. People actually made explicit plans. And this is what we think we can save. And then somebody was held accountable, preferably the same guy who's pushing so hard for this acquisition. Give him the advantage and give her the, oh, you would want this, then you be responsible for all these nice numbers you're forecasting. It's amazing how much more conservative forecasts will become when people realize that they have to actually start to deliver on it. Because otherwise, I mean, I've sat in on bankers pushing up numbers and there's no constraint. You go, let's go up 10%, or not high enough. Let's push up 50. Nobody's held accountable of those numbers. Why would you ever constrain yourself on how high growth can be or how low cost can get? So it's part of that accountability part, the process. So when we come back on Wednesday, I'll finish the last pieces of the acquisition puzzle, but the bulk of the mechanical side is already done. So think about a big deal in the works, Microsoft, Activision, think about what the potential value added is and how you would put numbers on it. It's a good exercise in thinking through what these buzzwords actually mean. I'll see you on Wednesday.
Last piece of the project. We found 11 companies that actually to my sector in the world. 11 to 15 companies. Is that right number or am I So now my company is losing money last year, so I cannot. There is no EPS for that.
We forward numbers. That's why I said yesterday we have money. Portion of today's numbers for that trend. Use your forecast for numbers. When you can see a more, use that.
So let's say next year or even on that.
Go all the way to your 10. You better put that in there. Get four price and discount that price back exactly.
Okay, then use that number. Okay. That totally makes sense. And so with this solar panel, I mean they're basically not manufacturing anything. They are buying solar panels in China and just they are buying them in China and investing them. I mean applying them in China, and the only thing that they're making is by selling the electricity to those businesses. That's what they're making. So I don't have, and then what all independent variables can I use in the rest? That is
What your company does, it's nothing to do with that, right? You pick a multiple, the variable will go into that multiple, are going to be driven by that multiple. So you need to sales, so the operating margin, but nothing to do with what your company does and how it does.
okay. So